Is inflation back with a vengeance? I mean, that's literally the question rippling across every trading floor today. Hello, and welcome to AI Market News by LM. Today, we're diving into a comprehensive explainer of the absolute macroeconomic shockwaves hitting the financial system right now. In this explainer titled U.S. Inflation Reignited, Next Fed Rate Hike, we're going to break down the cascading effects of a highly surprising U.S. inflation spike. We'll look at exactly how this is impacting major U.S. equities, shifting global currency pairs, and entirely rewiring market expectations around a potential Federal Reserve rate hike by 2027. We've got a ton of ground to cover, so let's jump right in. Section 1, Inflation Reignited. Let's look at the catalyst behind this market shockwave. So according to various news commentary, the market initially tried to shrug off today's data right at the open. But reality quickly set in when we saw this number, 3.8%. Based on the prepared resources, the U.S. Consumer Price Index jumped 3.8% year over year in April. That is the highest level of inflation we've seen since 2023. It's a bold print for sure, and it's actively eroding paychecks and forcing a rapid reassessment of our entire economic landscape. A huge driver of this pressure is energy. As seen in the provided information, the ongoing Iran war is driving up oil prices globally. West Texas Intermediate, or WTI crude, recently blasted past $102 a barrel. This geopolitical conflict is putting a direct and heavy squeeze on everyday consumers right at the gas pump, and that's rippling through the broader economy. And it's not just energy either. Let's look at the specific key inflation drivers. We're seeing ground beef cross over $7 a pound, driven in part by a 75-year low in domestic cattle inventory. I mean, 75 years. Alongside food, we're dealing with surging rent and airfare costs. And of course, those high energy and gasoline prices, which are up roughly 50% since the conflict began. It's really a multi-front squeeze on the wallet. This brings us to a really crucial perspective from the Federal Reserve. Chicago Fed President Austin Goolsbee recently noted, and I quote, "If we see underlying economic overheating, the FOMC has to think about how to break that chain." Goolsbee specifically expressed concern about service inflation accelerating entirely independent of the energy sector. This signals broad, sticky price pressures that the Fed just can't easily ignore. So how is the bond market reacting? Well, it's pricing in a totally new reality. Swap markets are now indicating an 85% probability of a 25 basis point rate hike by the April 2027 FOMC meeting. The odds of a hold are down to just 15%. Actually, the narrative has rapidly shifted from when are the rate cuts coming to the very real possibility of further tightening. Moving on to Section 2, U.S. equity market reaction. We're seeing tech and semiconductors pull back. Here we can see the S&P 500 board reflecting a market in deep transition. Like we noted earlier, there was some initial resilience, but as the reality of sticky inflation and rising treasury yields took hold, that resilience turned into a tech-led sell-off. Simply put, higher yields generally make those high-growth tech valuations much harder to justify. Breaking down the major indices, we can see this divergence super clearly. The Dow Jones managed to eke out a slight green close, up 0.11%, kind of leaning on more defensive and cyclical names. However, the S&P 500 dropped 0.16%, and the tech-heavy NASDAQ took the steepest hit, falling 0.71%. Now, what's absolutely fascinating here is the specific damage to the semiconductor sector. The widely watched Philly Semi Index closed down roughly 3%. This is a pretty heavy hit after a massive prolonged rally. What makes this pullback so interesting is that it's happening despite a 5% year-over-year surge in underlying technology spending. Basically, the macro environment is currently outweighing sector-specific strength. Section 3, Global Currency Pair Shifts. Let's explore the Forex and bond ripple effect. Based on the input sources, we're seeing significant US dollar strength across the board. Looking at the European pairs, the euro to US dollar pair dropped 0.32%, down to 1.1745. Meanwhile, the British pound lagged even further against the dollar, dropping 0.58% to 1.3530. It makes sense, right? When US yields rise on inflation fears, capital just naturally flows right back into the dollar. We definitely have to talk about the crucial USD/JPY pair, which is currently hovering right near 157.72. We're on high alert for official currency intervention from Japan, but as of now, there hasn't been any. The yield gap between the US and Japan remains historically wide, keeping that upward pressure on the pair. Furthermore, as a major energy importer, Japan's trade balance is being negatively impacted by those high oil prices we discussed earlier, further weakening the yen. Over in Europe, there's a whole other layer of complexity. The markets are reflecting real anxiety over UK political shifts. Prime Minister Keir Starmer is facing political instability and calls for resignation following heavy local election losses for the Labour Party. And this brilliantly illustrates how political risk translates directly to market risk. This political uncertainty in the UK, combined with market fears of a potential shift toward higher fiscal spending to win back voters, has driven UK 30-year bond yields to literally spike to 5.81%. To put that into perspective, those are levels we have not seen since 1998. All right, Section 4, Gauging Market Sentiment. Let's navigate the fear and greed in the market. We track several key indicators within the CNN Fear and Greed Index to see if investors are shifting from greed toward fear. We look at market momentum, comparing the S&P 500 to its 125-day moving average. We assess stock price strength by measuring net new 52-week highs versus lows on the NYSE. And crucially, we track market volatility using the VIX index. Right now, slowing momentum, narrowing breadth, and an uptick in the VIX are signaling that investors are getting decidedly skittish. Finally, Section 5, Upcoming Economic Schedule. What should we be watching next? Looking ahead at the economic calendar on investing.com, the crucial thing is preparing for Wednesday's data drops, all in U.S. time. At 5:30 a.m., we get the U.S. Producer Price Index, or PPI. The month-over-month forecast is 0.5%, with core PPI expected at 0.3%. This is going to give us a massive clue about wholesale inflation before it even reaches the consumer. Then, at 7:30 a.m., we have U.S. crude oil inventories, with a forecast of a 2 million barrel draw. Given all the energy pressures we've discussed, this inventory number is going to be heavily scrutinized. That wraps up our deep dive into today's market dynamics. We'll definitely continue to monitor these inflation metrics, currency levels, and yield curves as the data rolls in. But the ultimate question remains, will the Fed be forced to shock the system with a hike, or will the economy cool on its own? We're just going to have to wait and see. This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Thanks for watching. Don't forget to like and subscribe.